So there are a lot of behaviours in the Act and in the King IV governance report that guide a director as to how to act in the best interest of the company with due care and skill in the fiduciary capacity with the best interest of the company in mind. So directors need to make themselves aware of all of those. But in the event that a company does get sued, it's very important to ensure that the correct directors and officers liability cover is in place to cover legal fees and potential damages. So in the next of this series of videos, we just go a bit further into fiduciary duties of a director, remembering that what a fiduciary duty is the need for a director to act in the best interest of the company at all times. Failure to act in that way could lead to joint and several liability, as we've touched on, and we've spoken a little bit about the things that directors can do to mitigate those risks. So some examples of where a director could be held liable is if they have committed the company to some kind of contract where they didn't have the authority to do so. Any action to defraud either a staff member, SARS, a creditor, a shareholder would be obviously not in the best interest of the company. And another one would be, signing off of financial statements where you know that they are not fairly representative of the financial position. Right, to expand further on the duties of directors with financial statements, firstly, a director needs to understand the industry that the business is in and the activities of the company and any changes that occur over time. They need to be familiar with the financial position of the company. They're not necessarily needing to be experts. They can rely on management and can even get external consultants to give opinions as needed. The full board is responsible for signing off on the financial statements. So whilst the financial director might have a big part to play in convincing the remainder of the directors that they can sign off on the financials, it's really up to each director to understand them themselves. In an Australian case recently, as an example, all the directors were aware of a liability that the company had incurred, but in the financial statements it had been disclosed as a long-term liability, which means that it will be paid after 12 months. The fact that it then was due within 12 months and caused the company massive liquidity pressures, which ultimately led to the company folding, meant that shareholders could sue directors for not understanding the financials and signing off financials which they should have known were incorrect. In the next of the series of videos, we look at ways that directors can mitigate their risk. The first one is that they need to understand the activities of the business, so they need to be reasonably informed. They need to understand in the Companies Act what is codified there as behaviours that are needed of directors, and also the recommendations of King IV, which are not necessarily codified unless you're a listed company, but are recommendations on how to behave as a director. If a director is ever sued, there's something called the business judgment rule, which they can rely on to mitigate their risk, to show that they've acted in accordance with the Companies Act or King IV. The business judgment rule basically says that a director must take steps to be informed of the activities of the business and to stay informed. There should be no personal interests or no conflict of interest in any decision. There needs to be a rational basis for any decision that has been made, and it needs to be properly minuted. If this all happens, it gives the director some kind of defense if they are ever sued. As long as they've made decisions in the best interest of the company with all the information at hand, their chances of success are great, but they can still be sued. If the Memorandum of Incorporation allows for directors to be indemnified, they can then take out directors and officers liability insurance. What this does is assists the directors, should they be sued, for legal costs to defend it, and potentially also the damages that may need to be paid thereafter. It's a specialist area of insurance with lots of exclusions and endorsements that could potentially be enacted. So it's something that really companies should look to specialist brokers to provide.